Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, February 17, 2016. Here's a daily chart of the SPY or Spiders, which is the mirror image of the S&P 500. We had another big, healthy update today. While the S&P was up over 30 points, the Dow was up 257, and on and on and on. Another big day for the NASDAQ and another big day for the Russell Index or the IWM, which we'll talk about in a couple of minutes. So the question is, where does that leave us now? We have important stuff today to discuss. So let's go through in detail what we've got going on. As you know, I sold the three positions we bought last week, Amazon, Netflix, and the QLD, which is the 2 times NASDAQ market or two times the Qs. And the reason I did that is because there should be a turn coming up, and we'll cover that in detail in a second. But I obviously left a little bit of money on the table in a couple of those positions, but no big deal. I would rather err on the side of caution because we are now in the zone, and for more than a couple of reasons. There's a number of reasons why. This rally that we've had over the last 4 days is long in the tooth. So down here on the, let's see what day that was, on the 11th of February, we hit a low of 181.09, okay? So 181.09, today we're up at 192.88. That's basically around 120 S&P handles or S&P points. So when the market gets extended like that in a rapid fashion over 4 trading sessions, then it's getting long in the tooth. But that's not the primary reason why I sold those positions. That's part of the reason, but it plays into the bigger reason, which is, we're coming up into what will be a very, very strong level of resistance. Now, we're still a little bit of ways away from it. The level of resistance that I'm referencing is around the 195 area. It could actually come in at about 194.5 to 195.03. I've got 193 up as the red line up here. That's the calculation that came out. But if you look at this big down day right here from the 13th of January, there was a lot of volume, 220 million shares. So for us to get through that level after 4 up days like we just had, we've really got to come into it with more volume than we had over the last 3 trading sessions. The last 3 trading sessions were basically 135 million shares or less, and that was today, so that was the largest day. So what I'm thinking is that we're going to come into a lot of resistance, but here's the kicker. The kicker is that we're once again into a daily cycle turn day coming in basically tomorrow. So what that means is, now you can trade up into a daily cycle turn, or it can turn on a gap down in the morning. We just don't know how it's going to play out. If I knew that, then, it would be all bets are off, and basically it would be like printing money. But the market never gives it to you that easy. It's just the way it works. But the fact that we have a cycle turn day coming tomorrow, which is Thursday the 18th, it's plus or minus 1 day. So it could have concluded today. It may conclude, meaning the up move could have concluded today. It could conclude tomorrow or even extend into Friday. But we should be now in the zone where my expectation is that we should have a pullback in the market. Will this be the turn down for the next larger move down? We don't know yet. It remains to be seen. After 4 days like this, we could certainly just have a minor pullback, and then we could resume the up move, making a final thrust up to 195, 197.5, maybe even 200, 201. That's certainly possible, but the market never moves fully in a straight line all at once. So you have to expect that we'll have some kind of pullbacks along the way. And one of those is what I expect to begin over the next day or so. So the fact that I don't know whether this could be the larger move down, or whether it could just be a 1 to 3 or 4 day pullback and then the move higher could resume. We don't know that until we're in the middle of it, and we'll get a better sense for what's taking place as it's taking place. But I wanted to err on the side of caution, so I wanted to pocket the profit I had in those 3 positions. I think that was the prudent thing to do. More importantly, I don't want to get caught in a downdraft, because as we know, during bear markets, big swings in both directions will occur. I mean, look at the type of swings we've seen just in the last 4 trading days, and not even the last 4 trading days. It's actually basically every day this year. I mean, if you look at every single trading day this year, the range has been at minimum of 20, most of the time 30 points in the S&P in any given day. So if you look at these days here, even just in the last 4 trading days, 30-point swing, 25 to 30-point swing, 25 points right here. So the high was 189.81 and the low was 187.63. Today, we were up over $3.50 on the spiders. So on the down day, that does occur when it should occur, whether it's tomorrow, Friday, Monday. You can expect one of those days only in red, meaning to the downside. So that's what I see coming. I see us having a pullback beginning sometime over the next day or 2. So we're in the zone right now. So I wanted to make sure that everybody was aware of that. That's kind of the big news that I needed to bring to your attention today. Nothing moves in a straight line. We could certainly see the market push higher tomorrow and turn from a higher level. That's not out of the question. I wouldn't be surprised in the least bit. In fact, by Friday, we could certainly find this market up at the 195 level, potentially even run into the 50-period moving average, which is the downsloping blue trend line. That's not out of the question. I'm not suggesting that can't happen. I'm just suggesting that at this point in time, the odds are being reduced each and every day with the type of moves that we had over the last 4 days, that moves like this continue day after day after day. The odds on us seeing 6 or 7 up days in a row like this are much, much less than 3 or 4 up days in a row like this. And that's the philosophy that came out of the sales today, okay, the selling those positions. Okay, so let's move on and let's discuss the IWM. There's really nothing to discuss. It was up nicely. It was up on par with the S&P, only slightly more. It was up slightly over 2%. The SPY was up 1.85%, and the actual S&P index, the cash index, SPX, was up 1.65%. So we're into a lot of resistance right here in the IWM. So the high of this down day here on the 5th was 100.44, and the close today was 100.43. That's no accident. That's not a coincidence. That's how the markets work. What the market is telling you is that the high of this big down day on the 5th of February was important. And the fact that it was important is solidified by the fact that the market closed today 1 penny below that level. Okay, this is the way the market works. It's not a coincidence when those things happen. So I wanted to bring that to your attention. It's kind of further evidence of the fact that the market is going to run into, and is running into right now, a level of resistance that will probably be a precursor to a pullback. Whether it's a large pullback or a small pullback remains to be seen. We'll see. It could be a sideways move. We could see, and this applies to the spiders or the IWM. They're going to trade together. But it could be a sideways move to work off some of the short-term overbought condition and then a resumption of the up move. That's possible. Or we could have a sharp decline to scare everybody out of the market. And that would be certainly common and normal market behavior. So the other thing is, this is options expiration week. You will have on Friday options expiration. So therefore, it's certainly not out of the ordinary for the market to have a unexpected move in the opposite direction as what it's had for the first 2 days of this trading week. Remember, Monday was closed, so Tuesday and today are the 2 trading days of this week. And it's certainly possible and expected behavior for the institutions to play games with the market and whip it around a little bit and scare everybody out. Now that everybody began to buy calls yesterday, they certainly want to cause those people some havoc and pull the market back for a day or more, making those calls go rapidly out of the money. Because what happens is, if you're not familiar, there are weekly calls, there are monthly calls, and there are quarterly calls. The weekly calls are played as a higher risk play, and when the weekly calls, they have no, basically at this point in the game, calls expiring weekly on Friday, for example, have no time premium. So if they run out of the money rapidly tomorrow, for example, those people will run for the exits and try and salvage what profit or what money they have left in those calls if the market pulls back tomorrow. And that's what the institutions count on. Those weekly calls are more of a gambling device than anything else. But if you're right, you can make money in fast fashion. If you're wrong, you can lose money in fast fashion. So that's the way that works. So I just wanted to bring that to your attention. So let's go over to the transports. The transports had a nice healthy update today. And as you can see, we had another follow-through day, but you are running into a lot of resistance. Once we get up into the 7,600 area, where we're not there yet, that's going to be a tremendous amount of resistance, as evidenced by the fact that the market was spent a lot of time bouncing around trying to get through that level. This was a breakdown point, and then the market tried to rally back up to that level and failed, and then finally broke down. Okay, that level will be a tremendous amount of resistance, although we're quite a ways away from that. But this is basically a make it or break it area for the market, the transports. But we may not get up to that level. We might not get up to that level before the major market turns back down. And B, we might not get up to that level before a pullback in the major market. Either way. Okay, but that's your very, very strong level of resistance in the transports. All right, let's run over to the gold market. There's nothing to discuss. Gold had a flat day for the most part. And we're still, vacillating around, and there certainly could be further pullback, but it wouldn't be unexpected if the major markets, stock markets, pull back tomorrow or Friday or Monday. It wouldn't be out of the ordinary for gold, since of late it's been inversely correlated to the stock market. It wouldn't be out of the question for gold to see a bounce, since it had a pretty big pullback from the high up at 1260. What was that number? The high was 1263.90. Okay, we ran all the way back down below 1200 in just a couple of trading sessions. So it wouldn't be out of the ordinary to see gold bounce up again. But there's no trade in here right now. We've got to wait for a better trade setup. There's nothing to do in gold. Just wanted to touch base on it. And we'll do the same for silver. That was the continuous contract. Here are the levels, in case you wanted to see the levels that we've identified. We haven't got down to the first level of support that I identified at 1181 for gold. And in silver, we would likely pull back first to the 200 period, which we hit yesterday, and then back to the 1502 level was my theory, my thinking, and my math. And so there's no trade in here now. We'll have to see how the market reacts and formulates a pattern that we could potentially gain some evidence for a further trade in gold and silver. But just wanted to touch base on those two. There's really nothing to do at this stage right now at this point in time. Let's flip over to the crude oil market. In the crude oil market, we had a nice, healthy, big update today, up over 8%. And this is basically, some short covering, some panic buying, some speculation, all kinds of things. And, this is one of those markets, like I keep saying, it's very difficult to trade because you just don't know what one day to the next is going to bring in terms of larger moves. I'm comfortable waiting for the crude oil market to elevate farther to the upside, and then I'm happy to take a short position. But at this stage, I would rather play it that way. And if it turns back down without me, so be it. But I'm not at this stage willing to play it on the long side. And at this stage, I'm not willing to just yet go in on the short side. But it is a sell the rips market, not buy the dips. So you can buy the dips and get lucky, certainly, but I would rather sell the rips, meaning sell the rallies in the crude oil market. You did close today above the 20-period moving average, which is a bullish sign typically, but the 20-period moving average is not necessarily that strong of a moving average at this point in time as it may otherwise be, primarily because look how many times the market traded right through and back down, or right down and back through the 20-period moving average. The more times the market goes back and forth through a moving average, or through a trend line for that matter, the less important that moving average or trend line becomes. The first hit is generally the most important hit and will produce the most important price reaction. But the more times a market hits a level, whether it be a moving average or a trend line, the less important that moving average or trend line becomes in terms of being a support or resistance level. So while it's important that the market closed above the 20-period moving average, it's less important in terms of the bigger picture. If the market's going to rise, let it rise, meaning the crude oil market, and at the appropriate time, I will be happy to jump on the short side, and certainly will let you know when that will be. It could be back up here at double top if we get there, or I may wait for higher numbers dependent upon how the market gets there and what's happening at that point in time with the stock market, with the dollar, with all the other markets I watch. And so I'm happy to let you know what I'm doing, only at this point in time, I can't tell you exactly where that number would be. What I can tell you is that if we did get up to the $37+ area, between 37 and 38, as I sit here today, I am about 98% sure that I would be taking a short trade at that point in time in the crude oil market, and we'll leave it at that for this point in time. Okay. Let's go over to the bond market, and the bond market had a nice healthy down day today, and we're also getting into the zone right now in the bond market where my expectation is that we will find, whether it's today or in the coming day or two, we will find the bond market rising again. I think we're at a pretty good level of support right here, and I don't think that the up move is finished in the bond market. While this big up day with this tail on huge volume was an important turning point in the bond market for the short term, I don't think that the bond market is finished going up for the longer term. And when I say longer term, I'm not talking about years. I'm just talking in terms of weeks. Like, for example, when the stock market makes a turn down in earnest, my expectation is that the bond market will once again catch a bid and go higher once again. So whether it's from today's closing price or over the next day or two, I think this is a good support area for the bond market. One of the members actually asked me that very question today, and what I told him was that I think this would be a reasonable level to be long the bond market right now, whether it's via the TLT or any of the other vehicles that are long the long-term treasury market. I think it's a reasonable trade at this stage of the game, as long as you know where you're wrong. And at this point, where would you be wrong? Well, the first area you would be wrong, well, let me do it this way. I'll go over to the TLT, and we'll use that chart as a better proxy. So we kind of almost touched the 20-period moving average today, missed it by a touch, but that's close enough. This was also a gap fill. So if we look at the closing price of 128.72, okay, and let me put that level in. 128.72, okay, this filled a gap. Today the low was 128.71. You see how that works? That's not an accident nor a coincidence. The market came back down. It filled a gap left, and it just touched it by a penny, pierced it by a penny, and then reversed higher. What that tells you is that that gap was A, needed to be filled, and B, a level of support. And the gap, as it turned out, was more important than the 20-period moving average. But let's take it one step farther, and let's draw in a Fibonacci retracement, okay? And if we do that, we can see that, in addition, we're right into the 382 retrace. So we have a gap fill, 382 retracement, and one more thing, okay? This pivot high is also an important price level in the market, okay? Why? Because the market rallied up to that level and sold off. Okay, once we got through that level over here, okay, if I just translate that level over to this side of the chart, once we got through that level, it was a breakout. Now we've come back down to the 382, filled a gap, and also that prior pivot, okay? So there's three reasons why this is an important level on the charts. And this would be the reason why I suggested to the member who asked about the bond trade today that it was a reasonable trade to be long the bond market. Even if it's not going to run to new highs at this point, it should be a pretty good level of support for those reasons. Okay, so that was not only a little lesson in the bond market chart or the TLT chart, but it was also a lesson that applies to any chart because they're all the same as far as I'm concerned. I'm not concerned with what the label is at the top of the chart. Okay, whether it's a stock, TLT, SPY, it makes no difference to me. You know this. What I am concerned with is the actual chart and what it's telling us, or what it's telling me, or what it's telling us as technical analysts or those that are trying to continuously learn the type of technical analysis and market analysis that I try and provide each and every day. So those are the reasons why I suggested it was a reasonable trade to be long today, the bond market. Thought that we would find a level of support at that point. Okay. Let's go over to the dollar and then we'll wrap it up. The dollar had a not much of a move today. Okay, so we'll see if we put in, and this will be the tell, right? If we put in a sideways move like this, okay, or some kind of a wedge pattern, right? A bullish wedge pattern, that would be an up move, maybe a bullish wedge pattern, building energy for another move higher. Okay, at this point, we don't really have enough evidence to tell us which direction the dollar is going to move in the short run. So we want to wait for more time. Time is generally more important than price. And back to the spiders or SPY, it's one of the reasons why I put an emphasis on the fact that we're in the zone for a short-term cycle turn day. I do subscribe to the theory that time is more important than price. Okay, so the fact that we've rallied up and back, we're done with the dollar. So let me go back. There's nothing to discuss. We have to wait for more time to develop and wait for more evidence on the chart to tell us what the dollar is going to do. So there's nothing else to discuss. So let me go back to the spider and then we'll wrap it up. So we have two things working. We're not right exactly at an important price level. Had we been at 95 today, 195 today, 194.5, 195 today, and the fact that we are in the zone for an important turn, that would give me more conviction that the market was going to turn down. But we're at an important time period for a turn, but that's why I said the market could rally back or could continue rally up into the turn, meaning tomorrow. And if it rallied up into 195 tomorrow morning, let's just say for argument's sake, let's say that happened. Okay, we woke up tomorrow, we have a gap open, and we rally up into 195. Tomorrow being a turn day at 195, I'm here to tell you that's a stone cold short. No question in my mind. The time factor is important. The price is important. Time and price together is extremely important. But the fact that I didn't have two of them together, that's why it wasn't a short trade in the market today. Okay, it still may have been a short trade. We may find the market down tomorrow. But if we find the market up at 195, let's just say this week, okay, tomorrow and or Friday, okay, then it's a stone cold short, in my opinion. So with that note, I'm going to leave it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.